If there's anyone else coming in the room, we're a bit full, but there's some space around the side. So just for anyone who's new, and apologies for those who've heard me say this before, when I kicked off this morning, I talked about the need for speed and scale. How do we build a financial ecosystem that can unlock the scale of finance we need? Estimates vary. There are estimates out there that we need 100+ trillion by 2050 to build a net zero, nature positive world. That's about 3 trillion each and every year. Well, we've just reached our first trillion in green and climate finance. The UK apparently has mobilized something like 50 billion now. So things are really getting going, but it's very short of that 3 trillion a year. And one of the questions I had for our panels as we went through the day was, how do we industrialize the scale of financing? How do you industrialize it so that we can build the 100 green steel plants that is estimated we need by 2030, the 200 to 300 that we'll have to build in the 2030s to get us to 600 by 2050? How do we get the deals and transactions done so that we've got 7 million zero emissions trucks on the road by 2030? We've got 200 zero emissions ships with 6 green corridors. We have 20 to 40 commercial scale CCUS plants, particularly for industries like steel and cement and concrete. We've got 300+ commercial scale SAF plants. I think probably many people in here are investors. You've done your fair share of private equity, project finance, M&A deals, as I have during my legal career. And, there is no way that system, that bespoke system of doing deals and transactions could get us that many transactions, that scale of infrastructure and assets. So how do you build a system that almost industrializes that flow of clean infrastructure, assets, and grows companies? So I'm going to be quite interested. Are we ready? Nicholas, he's almost there. He's almost mic'd up, ready to come to the stage. So, private market assets and patient capital. So, Nicholas, I had a couple of questions from my own experience. So you're going to touch on private equity and patient capital. One of the debates that raged when I was the CEO of Carbon Tracker was a debate around whether divestment is a good thing or a bad thing. And for those of us who argued that divestment alone was a bad thing, it was because all these high carbon assets, we argue, would go from publicly owned companies with transparency to big bad private equity, which didn't have the same transparency. So I'm quite interested to hear a discussion around the role, a positive discussion around the role of private equity, and also the role of patient capital. It's come up again and again in the panels today, and the need for patient capital. Nicholas, over to you.
Great to see you. Merci beaucoup. Merci. And without further ado, I know it's a fast-paced conference, so we plunge, as we say in French, right into the heat of the action. I think Verena is a rapporteur, so if she may want to join us also. And without further ado, I'll start on my left. I'm going to ask each and every one of us to introduce himself in precisely 70 seconds. Alex, you start.
Hi, everyone. Is that on? Oh, yeah.
Yeah, on now? Yeah, okay, cool. Hello, I'm Alex Seddon. I lead the Catalyst investment strategy, M&G Investments. Catalyst is a very flexible private impact strategy. It's an evergreen fund, so we can take a very patient approach to investment, and we can invest anywhere in the cap stack. It's focused on driving impact, and it's a global strategy. Nice to be here.
Peter?
Hi, I'm Peter Backman. I'm Managing Director at Gresham House. We're an £8 billion listed asset manager, really focused around sustainability. My division is specifically focused in taking this patient approach to more a systemic approach to investing into sustainability. My view is that impact can actually drive returns, and that's a big part of our thesis. I'm also a member of staff at Cambridge Institute of Sustainability Leadership, CISL, as well, and I love sustainability.
My name is Nick Fursley. I'm the director of the World Pensions Council. We're a Paris-based international association, mostly of pension funds, sovereign funds, and endowments. I'm also the director of the Singapore Economic Forum and a co-founder without any executive role, so simply a co-founder and advisory board member, very long name, to the G20 and World Bank-led Global Infrastructure Facility, GIF for short, and I'm delighted to join you here today. Daniel?
Hi, I'm Daniel Valenzuela. I'm head of impact at World Fund. We're a 350 million climate tech venture capital fund. So we're basically there to de-risk technologies that private equities can invest into. We're similar, like Peter said, we believe that decarbonization will become a core value driver of our economy, and therefore really looking at environmental performance can be a predictor for financial return. And yeah, we recently were co-founders of the Venture Climate Alliance that ties into the whole GFANZ ecosystem of net zero. And we also published a white paper last week on the climate opportunity for mobilizing more investments into that space.
Great, and maybe Verena, a few words, just of introduction. This? No, this, sorry for that. I'm improvising here. To see if she's awake.
My name is Verena Chave. I'm actually a lawyer. I'm here because I'm actually reporting on what's going on here today, not as media, but as a member of the legal profession and somebody who's heavily involved in the ESG. So great to see everybody, and thank you very much for the invitation.
Great. So perhaps we can start with one of the main issues discussed earlier today, which is really the bloody crossroads. Excuse my Marxist parlance. The bloody crossroads where really climate finance and investment meet. So really there's a lot of talk, if you flip through the pages of the Financial Times or the Wall Street Journals, both prime ministers, presidents, CEOs keep on speaking, talking about the Paris objectives, past net zero, climate finance, etc. But in reality, things are not moving as fast as possible, and policymakers and public opinion are putting more and more pressure on the shoulder of investors, saying that they are supposed to be the main drivers behind, environmental friendly, climate friendly investment. So all of us here are involved one way or another in the E in ESG. So I'll start geographically with Alex to have his take on that issue.
Well, I think the first thing to say, people hear me okay, this is playing up. The first thing to say is that, to transition the global economy to a sustainable footing is like a multi-trillion-dollar problem, right? So I think it's clearly impossible to pull off what we're all trying to do without the redirection of trillions of dollars of private capital, right? There's just not enough money in the world. Governments, charitable sector, there has to be a role here, and it's a very, very important role. And then when you talk about the difference between public and private markets, if you look at the way the financial markets have shifted since the financial crisis, huge growth in the private markets across credit, across equity, infrastructure, real estate, those huge pools of capital have to be diverted towards impact and sustainability if we've got any chance of pulling off what we're trying to do in terms of transitioning the global economy. So I think for me there's no debate really, it's just that's what needs to happen. And then you come to more interesting questions about how do you actually pull that off. At M&G what we did was we took a private asset investment team, we pivoted them to impact, and we created a strategy that was incredibly flexible. So we can invest in credit, assets, and private equity. And we have a very, very long-term time horizon because we think that's kind of the best possible way of trying to go after this problem. So all of the different parts of the private capital markets have a role to play, whether that's seed or venture or private equity or infra or real estate. It all needs to be pivoted towards impact. Because without that, you just can't scale the businesses that we're going to have to scale or build the plants or shift the industry in the way that needs to happen.
That's right. And I think the structure of your team is quite unique because, the jargon we used, we tend to separate, on the one hand, asset owners and on the other hand, asset managers, and typically in general, GPs, general partners, are separate from their clients, and they have several clients. And there's a big Chinese wall separating, the asset manager from the asset owner. The biggest asset owners being the pension funds, central banks, endowment, insurance companies, excluding their third-party commercial fund management activities. And in your case, you just have one single client so far. It is the M&G insurance company managing its own money, correct?
Yeah, I mean, it's actually the Prudential Insurance Company fund. We have a 5 billion allocation to Catalyst. The Prudential fund is 140 billion. And I think, the nature of that fund is very long term and it's very big. And so, in our view, those large pools of capital really need to lead the charge in terms of driving innovation into these fields because they have the scale to take the level of risk that's required and they have the long term time horizon because that's what we need here when we're thinking about the transition. And ultimately, the customers whose savings we're looking after, we believe, want to actually play a positive role in this transition.
And so far, you've only run your mother's company or your mother's money, but you may open up to third-party investors, right?
Yeah, the second half of this year, we're going to open up to third-party investors. But again, we have the sort of scale and resources to test the investment thesis. We launched in Jan 21. We're 2.5 years in. And now once we've proven out the concept, we can open up and then scale.
Gotcha. Whereas Peter, in your case, you're a pure asset management company with third-party clients, right?
Yes, yeah. So my division, we've got 8 local government pension schemes, so UK government local pension schemes, and actually they're a very good provider of capital into the space. They're patient, they look at the long term, and actually what they now really want is they recognize that their members have got to be able to retire into a world that they want to. And so they're really, really quite focused now on actually the impact that they can drive with their money. So they're a great pool of capital for us. I think generally, like Alex said, there's a huge need for new capital. And actually, where we need to try to mobilize capital is more on the credit side. That's where the really, really big pools of capital. I mean, relatively, private equity is still quite small compared to those other pools. And, when I look at that pool, I do think actually the insurers have the really big opportunity because a lot of the big pension schemes are going into buyout. They're selling to insurers. The insurers are the ones that ultimately are probably going to allocate the capital on a long term. So to me, they're the ones that we really need to move the dial on to really do this at scale. But, I'm hopeful people are starting to move, but it is still a pretty lonely road. It's a lot of effort to try to get LPs up to speed on this. Most of them are still thinking renewables are the only thing that you need to do to fix the world. And actually, I think that's the big mindset shift. They need to take this more holistic approach. They need to look at the S and the G as well as what you need to be investing in because they're all impacting each other. And the other one is nature, is probably the final one. Everyone's talking about TNFD and the biodiversity side, but that is really, really big part. We've trashed nature. We've treated it like a free public good, and it's not. It's fundamental to all of our system worth and our economies. And I think that is another area that we can divert capital into. We've got a specific business in that, investing into big landscape scale habitat banks. That's where we're going to start to move the dial, both in environmental and social and governance.
And you guys include, for example, vertical farming within the E-scope, right? Or the E-remit?
It's E-remit, but I think it also has social and governance aspects as well. But yeah, I mean, that is the future of food. That's like 1,900 times better from a carbon perspective compared to field-grown crops. We can grow 250 to 500 times more land efficiently than traditional field-grown crops, 98% less water, and the thing lasts a lot longer. So longer shelf life, less plastics, less microplastics in the water, which is causing infertility problems. So, it's environmental, but it has social and existential impact as well.
Right, and just one minor geographic remark. You guys, Gresham House, have a 95% plus UK or English, British focus, right?
Yeah, so my division, it's all UK assets to date, but we're currently looking at, for example, Canada for our next vertical farm, because actually in Canada, power price is about 3p per kilowatt hour, whereas we're paying about 27p now in the UK. So there's a big advantage to go to somewhere like that. So, we are now rationally looking at allocating capital to capture that sort of benefit because it's fully renewable.
Gotcha. And whereas, Alex, in your case, you guys were global from the start, right?
Yeah, yeah, it's a global strategy. Yeah.
Daniel, am I right? Go ahead.
In terms of our capital.
Focus, what we focus on.
So our investors come, I guess there's some UK pensions like the UK Environment Agency pension fund. We see that it's primarily the more progressive pensions that are actually trying to get into the space, which is a bit surprising given the importance for them and for kind of like the long-term challenge that this presents, and also the diversification opportunity in general, the financial opportunity. But we're overall focused in Europe, and yeah, for example, the European Investment Fund is another investor in us. They have done their largest ever ticket into a climate fund in us. For them it's a very, very strategic topic, so that's why we're seeing a lot of support from them, from their side, into climate.
And is it fair to say that you would typically invest in smaller scale, earlier stage companies or assets?
So we're a venture capital firm. We are sitting specific, and we're designed specifically for one gap that we see. So there's a lot of new VCs and coming to market in climate, but a lot of first-time funds, a lot of emerging managers that are relatively early on. But if you look at all the growth capital, all the generalist capital that wants to come into the space, you see that they actually don't have the targets to deploy to. And that's because we have a massive, massive gap around Series B stage, where there is actually where you need to take risks that are not really known to the market, first of a kind factories, kind of like bringing this initial technology to a scale that generalists and de-risking stage that generalists can invest into, and that's a big gap right now.
And what proportion of your portfolio would be green tech or clean tech?
100%.
100%. Okay, so it's ultra focused.
We only invest in companies that have basically the potential to avoid 100 megatons or more of yearly emissions. So it's a massive number and really narrows us down, but it really allows us to identify the winners of this upcoming transformation that will be the largest transformation that we've ever seen in our economy.
Gotcha. So for you, the innovation is like the core part of what you do.
100%. No matter what think tank you look at, for the goals until 2030, I think 30% need to come from novel technologies, solutions from novel technologies, and until 2050, 50% of the solutions need to come from novel technologies, meaning technologies that are at lab stage today. So that's why we're really investing in that part to solve that gap.
And you mentioned, the EIF, which is the European Investment Fund, arm of the European Investment Bank itself, the supranational investment arm of the European Union, which helps, a lot of, companies like yours. And when we talk to VC investors in Europe, they sometimes complain that in the ecosystem here, there isn't enough, seed money, and it's easier to be in Santa Clara, California, or the Shalom Valley in Israel or Singapore, and it's more complicated in Europe. What's your take on that?
So European Investment Fund is a very particular type of investor. It took us over a year to get them on board, so very, very tough, but at least they know exactly the gap that we're targeting, and that's why they were quite convinced. If we're talking about the important ones, as Peter just mentioned, with regards to the big pools, the insurances, the pensions, it is completely different if you compare US to Europe and UK with regards to their willingness to take risks and invest in emerging managers or in climate VC or even growth funds.
Gotcha.
So
Gotcha.
yeah.
Okay, great. Back to Alex, and earlier I think you mentioned impact as a central part of what you do, and I guess it goes beyond simply vocabulary. It's in the old days there was impact, it was small and marginal, and ESG or sustainability was the thing. And is it fair to say that now everyone wants it to be impact and measurable?
Yeah, I mean, I think the way we think about it anyway is you need to, at first, for Catalyst, you have to have a very clear ESG framework so you understand all the risks and you mitigate those, right? That's just basic. You have to do that as a starting point. And then you start thinking about how you're actually going to drive positive impact. And one of the kind of core ideas behind setting up the fund was that we were moving into a era of impact at scale, right? So if you look at the last 10 years, there's been huge amounts of very positive work, small scale impact funds around the world. But going back to the sort of process I was describing earlier, we're now moving into a phase where we need to take businesses that have got proven technology, they've got commercial traction, maybe they have one plant in the world, but for them to actually drive real impact globally, they need to open 50 plants around the world, right? So that's what we call impact at scale, and that requires a totally different approach. It requires whole investment departments, it requires billions of dollars to be diverted or to be raised into these funds and then to be deployed globally into significant businesses. And going back to this point about the capital gap, I think it's important to zero in on, there's different types of capital gap. There is one at Series B. But one of the interesting things is so many of these businesses, they need real assets, right? And, whilst venture capital has an important role to play here, typically they're very good at scaling software businesses, right? They're not so good at building big factories or financing big factories, right? It's equity for high growth software, right? And that is just not going to solve this problem on its own. Then you have the kind of infra equity part of the market, and that's also important for proven technologies where there's a very clear cash flow and it's a lower returning opportunity. There's tons of capital there. But the really interesting bit, in my view, is this scale up. Right? So you have a proven technology, you've got product market fit, you've got commercial traction, but there really isn't that many funds in the world focused on that and willing to take that kind of scale up risk and being able to do that in size. And actually, in my view, that's one of the biggest sort of gaps that we have across multiple sectors and multiple impact challenges.
Yeah. Can I build on that? I was just actually with some bunch of VCs last night, and actually they're all in clean tech, and they're all lamenting the fact that they can't actually follow their money because they all go in seed, Series A, Series B, and then they get swamped because actually deep tech, clean tech needs hundreds of millions at that Series B, Series C stage. And at that point, the challenge is that they've done all the heavy lifting at the front end. Team building, finding the right idea, dissecting it, getting it to product market fit is really hard. But typically, you don't necessarily get the uptick in valuation at that point to really get the full value of it. So it's a big challenge. And that's exactly the gap that we think about, is that we want to build teams from scratch. Actually, being able to do that gives you a lot more control, allows you to build the right culture and values in the businesses as well. And then you've got platforms that can scale. Our view is that do a relatively small investment to start with, and then build a platform, and then that could do hundreds of follow-on plants, kind of like we're talking about. And that's ultimately what we need to really capitalize on to drive real change, because there isn't enough of, I think, us out there doing this. And I think you're in the right space as well. It's just, we need more people at that early stage prepared to build teams in clean tech, deep tech, envirotech, solutions to the big problems.
There was a conference recently in Washington, D.C., and even though people were lamenting that because, interest rates were rising and sometimes, illiquid assets are punished when you have a rising risk, rising rates environment, I was talking to a lot of, Harvard, MIT, Georgetown, MBA graduates, and really everyone wanted to move to private equity, whereas, when I was their age, we wanted to move into listed stocks. So the world changed, and one of the reasons you hear talking to these MBA graduates is not only the pay, not only the fact that typically, the pay is supposed to be higher because of carried interest or bonus or whatever. There's another reason, which I think is more ESG related. Usually when you're within a PE or VC structure, for an equal amount of money, you can have a bigger impact on the asset. So if you look at asset owners, you look at sovereign funds, even the big Canadian, Australian pension funds, when they buy shares in Microsoft or Mercedes-Benz, even if they put billions of dollars, they end up having 2 or 3% of the capital.
Yeah.
Whereas, even if you're a mid-sized private equity firm, if there is an interesting, green tech or a vertical farm asset in Liverpool or Manchester, with the same amount of money, you can own 40 or 60% of the capital and perhaps make your voice heard, right?
Yeah, and where's the additionality if you're investing in a public company that's already done it? Unless you're doing an IPO, I don't think you're getting real intentionality, real additionality, and there's no intentional outcome there. Whereas with private markets, they're patient, you can build things from scratch. this stuff takes longer, it's probably going to cost more money. That doesn't fit the public market that well. And when you're building greenfield real assets, there's 7 or 8 years before they're actually accounting profitable. And that doesn't sit well in the public market either. So, it is a mismatch. And I do think that's why private markets are a more suitable venue for the sort of things that we're trying to do to create impact.
Right, and Daniel, it's fair to say that when you invest in these assets for these early stage companies, the management expects you to be more than just an investor. They expect you to give them corporate strategy ideas on a regular basis.
So one thing we do is we do kind of like the scientific assessment of how the technology fits into the transformation, into the theory of change, and this is one of the core things that our companies appreciate, to be really informed with their impact strategy, because they do believe in our thesis in terms of decarbonization driving business in the end of the day. Another thing they appreciate in working with us is obviously we have this platform of over 200 serial entrepreneurs and family offices across Europe that completely believe in the space and really want to contribute. And so opening the right doors, and very often they need to work with the incumbents in the market, and basically we have C-level at most of these companies in our LP base and can open the doors for them to these companies. So that's another big value add. And these companies, we touched upon it earlier, these companies are really, really strongly into turning their business around. The highest emitting industries have actually the most climate tech patents in-house. They're the most active acquirers of companies in the space, and they do all have what's called the innovator's dilemma, that they cannot, even if they want to, disrupt themselves. So they're completely dependent on such private markets to actually get this innovation and the long-term strategy.
And how much or how many of these innovations are transferable? So if there's a great researcher, let's say in Moldova or Poland, who comes up with a high-tech, clean-tech device, how often do you guys help him, market his thing and transfer it to a bigger market?
I mean, that's really the idea
That's the
of
idea.
our fund. Yeah, I mean, we want to identify the technologies that are promising both on kind of like traditional like venture capital business type of terms, and marry that together with the science and what the science, which is the best tool we have to understand, like this physical problem and how we can get out of it. And then when we see a strong team with a strong product that we believe will drive the decarbonization of that sector, we invest and help them scale. Yeah.
And what is like the proportion of entrepreneurs in your portfolio who come from Eastern Europe or emerging markets or Asia?
So we invest in Europe. We do have we have 12 companies in our portfolio right now, from a more business model innovation to hardcore deep tech, like a sales technology platform, a quantum computing company, or similar. And I think a third of them are actually from Eastern Europe.
A third, okay, so quite a high figure.
Yeah. Yeah. There's a lot of interesting, also there's unique challenges in Eastern Europe. For example, we've invested in one company called Sunroof that do building integrated solar and virtual power plants. And their core business is in Poland, also in Sweden and in Germany. But obviously every average grid mix, that generation that you displace will be by far the highest in Poland, because the renewable share in the energy mix is much higher in Germany and Sweden. So, yeah.
And perhaps, some concluding remarks, focusing more on the S in ESG and including, SDG 5, the role of women, social issues. So are you feeling a shift when you talk to LPs, when you talk to, insurance companies, your mother company, prospective investors? Are you seeing demand for metrics? So do you see them telling you, I want my whatever asset in Morocco to have at least 40% women, or I want my solar panels in Saudi Arabia to have at least 36% women engineers? Do you hear that from them?
Yeah, look, I think it's a really important topic. I don't think you can think about impact, innovation, business formation, scaling businesses without thinking about ensuring that the founder set, is diverse, or put it the other way around, making sure that capital flows to underfunded founders all over the world. So we've done a number of things to to help that, we're partnered with Antler, which is a early stage VC that basically has a very diverse founder group globally. The idea being that innovation is global, not based just around Silicon Valley. We've also signed up to the Investing in Women's Code. We are allocating a specific part of the Catalyst Fund to female-led GPs because we believe that's the best way of ensuring that you get capital to
worldwide.
female founders.
Worldwide.
Yeah, yeah, it's a super important topic. I mean, yeah, all of the issues that we're addressing in terms of carbon transition, in our view, you can't think about carbon transition without thinking about health inequality, right? They're also closely tied. And if all of the solutions are just coming from the global north with a load of founders that look like me, that's not really going to get us there. So, yeah, it's a really important topic. And the way we think about it is how does capital flow? And what can we do sitting in a mainstream financial institution to try and at least in some part offset the inequality in the way capital moves around the financial system?
So,
Yeah, I think it's multifaceted. So I think it's got to start from yourself and your own team. So my team is at least 50%, actually 60% women at the moment. We put DE&I policies into every company that we invest, and we want them to report against it, which is really important. There's no point having a policy if they're not actually doing it. And then in terms of what we invest into children's nurseries, which you might not think are naturally the most sustainable businesses, but these are new nurseries, and it allows one partner in the family to get back to work. And there's some really interesting study now that says actually if we could get proper diversity in the workforce, it's worth $27 trillion globally. So we're doing a small part to try to catalyze that workplace diversity as well. So there's a lot of different things you need to think about, but fundamentally that is going to be a really big driver because actually educating people in less developed countries, like the women in the less developed country, they have the biggest determinant on the sustainability of that family. So there's a lot of things that the S and the G stuff has really big impact as well, and I think there's not enough focus on it yet.
and I think we mentioned women empowerment and education, two of the main 17 SDGs. Do you guys at all use the SDGs in your investment process?
So I do think, I mean, it's tricky. So we're a large VC, so we actually try to allude to purely financially driven investors, which is why we try not to. I mean, there's so many arguments that, like, why you should care about these topics. It's also for climate justice in the sense that this transition should be driven by multiple voices, etc. So we're usually trying to formulate it in more business type of terms. So what we do is basically we work on an ESG action plan with each company. As Peter said, it's very like we are actually part of forming and guiding these companies, and particularly early on in their journey, it's.
Were you the one who mentioned the white paper?
Yeah.
Okay.
Yeah.
So maybe you should circulate the white paper to the attendees via Innovation Zero, perhaps.
Yes, happy to do that. But with diversity, it's one of the most important things to actually implement very early on in a company because it's really hard to do later on because it's very much in the culture, etc. But we have all the studies that this drives performance. We have actually, I mean, you can also look at it as a gap. If you look at our industry, which is completely male dominated, it's actually an opportunity. If there's biases, it means that these companies tend to receive less attention than investments, and therefore creates kind of like an supply-demand mismatch that we can also use as investors. And yeah.
Well, great. I think we have 30 seconds or 50 seconds yet, so I'm going to go back to every one of you and ask him to give us his 20-second. Not wrap up, but if he could wave a magic wand, what would be the thing you'd like to see done in the next 12 months in the ESG innovation space? In an ideal world, what is the thing that you think would help accelerate or catalyze, to use your metaphor? Alex?
I think one particular important area is this point about getting pension funds, more focused on these investment areas. There's not really the risk appetite currently if you look at the UK investing in private markets or growth equity. And clearly, given what we've just been talking about today, that is going to have to shift over the next 12, 18, 24 months if we're going to get enough capital into impact-focused, purpose-led businesses in the UK. So that would be a big one.
Great. Peter?
I actually just realised that we're such a cliche. We almost got the same uniform on today, so that's quite scarily eerie. In terms of what we could do to really make a difference, I think Solvency II and some other regulations to really drive insurance companies to invest into real assets or liquids would be great. The other thing is a carbon tax. I know that's not necessarily that popular with everyone in the room, but actually, if you look at the UK, they had a thing called the landfill tax that single-handedly changed the amount of organic waste that's gone into the UK waste stream. It's like 99% less than what it was before the tax came in, and it freely funds basically a whole heap of stuff that no one sees and does. So a carbon tax is my other change. That will really cause people to
I think
change their behaviors.
I think regarding the loosening of Basel and solvency, which will allow hopefully insurance companies, pension funds to put more money into private equity and ESG, I think your wish could well come true because there's probably very few topics where Labour and the Conservatives agree, and it's also very few issues where Eurosceptics and Europhiles agree. I think the only one is probably the loosening of Basel solvency rules in the UK in the coming quarters. So fingers crossed, hopefully that will happen. And that may give Britain or the City of London an edge vis-à-vis Frankfurt and Paris, probably. What is your wish?
These two wishes were just so on point, so I fully agree with
You
them.
concur?
And yeah, one last comment to the diversity topic. I think one completely notable thing in the climate space is that actually there's an order of magnitude more women-led companies than in other tech areas. So I think that's also quite a positive thing, and I hope that this perfect storm that is coming from all sides, from consumers, from employees, etc., is just gonna lead to pensions, insurances, and big asset owners to allocate much more in the space.
Before we move to the asset owners session, perhaps a rapporteur or rapporteurs, to use proper French syntax, could ask you a question, Verena?
I suppose the real question, which is being asked here today, is what does everybody see as the key challenge to their wish? Because I think that's really what we're asking, is what's stopping us moving, making these steps. So what do you see as the key challenge?
Or risk? What is like the biggest risk you see?
Well, on what we were just talking about, getting different pools of capital focused. I mean, I, ultimately, I think it's the decision makers, the allocators, the asset owners have to take a slightly different view on risk, right? I think you can't make a meaningful difference in impact unless you're willing to take some earlier stage business risk. I think that's just a reality because of this point about additionality, because of the need to scale these proven technologies globally. And so I think trustees and decision makers around these big pools of capital need to think more broadly about, yes, the risk return of the investment, but the broader societal risk of inaction.
I actually think probably ourselves, in a way. Like, I think government is the thing I'm slightly most worried about, where that could go. That could trip a lot of these things up. Political decision making isn't necessarily always aligned to these sometimes longer term goals. So that's what I worry about, is political risk now.
Mine is similar in the sense that a lot of large companies. I mean, change is a really hard concept for individuals, for humans, and I feel like a lot of companies are just holding on a lot to their ways of doing things, even though all the data is there that you can have superior performance if you go the greener you go, basically. And policy follows a lot of these big companies, and kind of like that's my biggest fear, that the companies do hold on too long, and there's not the embracement of all the data and all the opportunity that is in abandoning the old way of doing and embracing the new way.
So change starts with ourselves. On that cautious note of wisdom, join me in thanking our great panel today.